In this video, guys, let's take a closer look at what the different moving averages can display when we get an explosive move. Stay tuned. All right, traders, how is it going? I hope you're keeping the risk managed. Okay, so I've got 4 charts here, identical charts of crude oil on a 5-minute chart. On this left-hand side, I have, if I can click it correctly, a 5-period moving average, which I'll keep red. On this side, on the top right, I have a 10-period moving average, which I will change to orange. And on the bottom left, I have a 20-period, which I always have my 20 periods colored cyan. And then on my bottom right, I have a 50-period, which we will go green. Okay, so I like to use a 5 and a 20. That's personal preference. But what I wanted to show you is really this move on crude oil. Okay, we had a good drive, 2 o'clock, straight up. So you need to look at moving averages as tools that can help guide the type of trade that you want to make. And this is, I think, the secret of moving averages. If there was a secret, there's no secrets or anything like this. But if you're trying to catch short-term momentum and ride it while it's running, then using a 50 period isn't relevant. If you're trying to trail a trade and come out when the trend is very much at the end, should I say, or as most likely ended, then you might want to use a 50 period. So look at some of the options and advantages of different ones. So by the way, I've just used 5, 10, 20 and 50 because they're the main ones. Of course, you can use whatever you like. Now, what's a 5 good for? A 5 is good for really showing that short-term momentum. And so if you are on the momentum and you're on the trade and you're long, good for you. You hold that trade until that 5-minute period moving average is breached. So the first close below, you come out, bang, you're out. There's your exit there. And so you've run it all the way up, hugging, and bang, you're out. And similarly, when you start to touch that moving average, that's an opportunity to potentially add to the trade. Now, of course, you have to have your risk management, all this kind of stuff, but the 5 period is when you've got a good momentum, it will hug the 5 period and have 10, 15 closes above it before it finally closes below it. And so if the assumption is that, then when the moving average starts to catch up on this very slight backing off the throttle, there's your add. There's your second, there's your add, there's your third add, and you're finally coming out. So you're using it as a very, very aggressive tool to run up alongside price. Now, moving to the 10 is a bit slower, obviously, but the first pullback to the 10 on a very extreme move can often be bought. It's often that first pullback that can be bought. Now, let's not confuse things and start doing one thing and the other and coming out on your 5 and then only 10. No, you're trying to align it with what you're looking to achieve. If you think this market's going higher, you're like, fine, this is a great run. And by the way, you could not ignore the 100 whole number level there. You'd be foolish to. You'd have to kind of look at things in context, but we are just looking at these exclusively right now without looking at the bigger picture, which you never do in the real world, but just for kind of argument's sake, 10 period often is the first one to be bought. And so you can buy kind of this 10 period pullback or pullback to the 10 period. And then you kind of scale it out as you push into new highs. So that's something for that first pullback. But bearing in mind, the 10 works when you've got a very aggressive, steep trend, as we had here. That's why it's a great example today. Very, very steep. The angle of that is, very, very, very steep indeed. We're talking about 80 degrees almost. That's a really steep trend. And so when you get that, the more, or the shorter, or the faster the moving average you can use. 10 period comes back, kisses, pushes the highs. 20, generally this is, when the trend is not quite, this is a very brutal move, you can often buy this as well. This is often a pullback to this level, and I generally prefer the 20 to the 10. Personal preference. Let me know what you like to use below, guys. I was interested to hear your kind of combos for this stuff. First pullback to the 20 period is often, again, a time when you'll find some support. And we get this here. We get this kind of pullback here. And yes, there's a big wick lower. That's normal. It's normal to test liquidity and even go so far as to suggest, or my preference is to see a drive lower that fails and then a whip back up. So you get that kind of test and fake. It's like, hey, any demand, sure is, bang, supply comes in, then bang, straight into demand. So that to me is buyable. 20 period, again, back to highs. And if you have a larger view and perspective on this trade, you might well look then for a continuation of this. So there's your 5, there's your 10, there's your 20. And 50, for me, this is something that you would probably look to use as a trailing stop only, or even a reversal in some cases. It's too late, it's far too long to kind of justify going long. And this, I know it happens to be that case here, but I think it's way too slow. By the time the 50's caught up to price, it's done. Now, in a good strong trend, you're going to have the tide with you and you're going to be able to buy at various points and again and lift back up. But if you're trying to trade the momentum, which is kind of the idea of this, the 5 is the most aggressive, 10 second, 20 period. The 50 feels like the momentum's died off. And when price starts to break below that 50, you probably don't want the trade. So in which case it's quite valuable as a stop loss indicator. Hey, I'm going to trail this. I don't want to be aggressive and start coming out on the 10 or start coming out, because I think there's the first kind of pullbacks. They could go and do another leg of the same order of magnitude of this. Another $3 leg would be very nice if you're long. But then if the 50 comes back and it trails and it tags at 50, then I'm out. So that's one way of doing it. So steep trend, steep aggressive, momentum move, 5 trail, add if you're super aggressive, pyramid, manage risk, of course, no recommendations, guarantees, or that type of stuff. This is just me visualizing and sharing with you what is a nice framework, I feel, and a way to look at the market. 10 period, that first kind of pullback, 20 period, the kind of second rotation, be more cautious, be more careful. Often you get a plunge below before it pulls back. That's the sort of trigger you'd like to see. And then 50 acting as a trailing stop. Does it always work like this? Absolutely not. Is it as useful as a guide and using the right moving average for the conditions? I think it's worth further investigation. Take care. See you next one. Keep your risk managed. Bye bye.